All right, well, welcome to our third PSL demo day. I am Jason DeBacker. I am a professor of economics at the University of South Carolina. And I'm, for this talk, most importantly, I guess, a core maintainer of the model Cost of Capital Calculator. And what I'm going to do today is I'm going to take you through a demonstration of the web application of Cost of Capital Calculator and show you how to use it and how to interpret the output from that model. Okay. So the first thing I'll do is I'm going to share my screen here. I'm going to go to a web browser, and I'm at Compute Studio /PSL model /cost of capital calculator. So this is the domain for the web application for the cost of capital calculator model. You'll notice here in the top right, I'm logged in. To run this model yourself, you'll have to create an account on Compute Studio. You'll just need an email. And then once you do that, running the model is free, and your email will be helpful because you can have an email notify you that your results are ready. But this model runs pretty quickly, so we should be able to do the demonstration live here. Okay. So first of all, Cost of Capital Calculator is a model that's used to estimate the effects of the tax system on incentives for businesses to invest. And so kind of in that capacity, it computes measures like the cost of capital, the Hall-Jorgensen cost of capital measure. It also computes some other measures of how the tax system affects investments, such as marginal effective tax rates and average effective tax rates following the methodology of Devereaux and Griffith. Okay, so with that, let me go to the app here. And so in the two other previous PSL demo days, both of those were also using web applications hosted on Compute Studio. So you'll see that this kind of layout here is very similar to what you've seen in those other demos. So when we go to create a simulation, there's the opportunity to title your simulation. So we could kind of title this, for example, today's date, and that it's PSL demo day. You can add some notes about this simulation. And then below that, you have the ability to start to enter inputs here. So there's a few different categories here. So let me kind of walk you through what you can change with this cost of capital calculator. So in the top left are just kind of meta parameters. So you can change the default start year. We can make this, rather than 2021, we can make it 2022 or any year right now up through 2030. We have the opportunity to select the data source. This data source is what's going to be used when we compute individual income tax rates that will affect incentives to invest, because they'll affect the marginal rates that individuals face on their savings. So we can choose either the IRS public use file or a CPS-based file. And if we change those parameters, what we'll want to do is kind of hit reset just to make sure everything updates to those new year parameters. Okay. If we look here on the left, it'll kind of highlight the different categories of things we can change. So there are business tax parameters. So those would include things like the corporate income tax rate and depreciation rules. And then there are individual and payroll tax parameters. So those are parameters that feed into the tax calculator model. That's something that you saw used 2 weeks ago when Peter Metz demonstrated Tax Cruncher. He was adjusting some of those individual income tax parameters. And you can do that for cost of capital calculator as well, because when we compute marginal effective total tax rates, kind of the total burden on an individual savings, taking into account business entity level taxes and taxes on the individual, we'll need to know what those individual taxes are. We may want to think about how, for example, incentives to invest change as capital gains tax rates or tax rates on dividends change. So there's the opportunity to adjust those parameters in this model as well. All right. So it's kind of a high level view. Let me take you a little bit more into the weeds. So with business entity level taxes, we can change the corporate income tax rate. There's a flag that we can set. It's by default, it sets to false like current law, but if we set that to true, that would treat pass-through businesses as corporations, partnerships, sole proprietorships like C corporations and tax them at the entity level. And we can then choose, if we set that to true, we can choose what that entity level tax would be on those businesses that are currently pass-through entities. we'll see in the results that we'll be able to look at the effective tax rates on both corporate and non-corporate entities. And so we can change parameters separately for each of those. We have a number of depreciation rules we can change here. We can change whether or not there is bonus depreciation, and if there is, what rate it's at. So under current law, property with 20-year lives or less has full expensing, so 100% bonus depreciation. So the default here is 1, that is what current law says, but we could change these values, perhaps just giving 50% bonus depreciation to these pieces of equipment. Okay. In addition, there's some, you can put limitations on financing. For example, limits the deductibility of interest for corporate or non-corporate entities. You can set up, if you wish, an allowance for corporate equity. So this would, if you had deductions for interest expenses, if you wanted to treat debt and equity financing similarly, you could set up an allowance for corporate equity, allowing corporations to deduct essentially the costs of their distributing dividends to shareholders. And then there's the opportunity to enter investment tax credits and property tax rates as well. And so those are some of the tax parameters kind of at the business entity level that you can change in this web application. There's some more flexibility if you were to run this model from the source code to change more specific parameters of the depreciation schedules, but on the web application, we're just keeping things simple, and you can adjust that bonus depreciation parameter. There are other parameters that enter into this model that aren't policy parameters, and you're allowed to adjust those in the web application as well. So this includes kind of how inventories are accounted for, how investments are financed. So you can enter the fraction of investments that are financed by debt or equity into this web application. You can also adjust, for example, the number of years inventories are held and profit rates and other parameters that affect some of these calculations of marginal effective tax rates or average effective tax rates. Individual level taxes can be adjusted by just entering new marginal rates on certain income, or you can enter the tax calculator parameters below. So I'll kind of skip over those. And then there are some economic assumptions that are relevant for these calculations, namely the inflation rate and the nominal interest rate paid on businesses borrowing. And so you can adjust those parameters as well. And then below that, we get to the individual and payroll tax parameters. And again, this will look just like the tax cruncher model or the tax brain model that will be demoed in a couple of weeks, where you can adjust many parameters of the individual income tax code. Let me focus on the above. So I changed the bonus depreciation to be just 50% rather than 100%. Let's change one more parameter here, and that'll be the business entity level taxes. And we'll just, President-elect Biden had proposed during the campaign a rate of 28%. So let's just change from the default of 21% to that 28%. And then once I've done that, I'm going to hit run. And I can have it email me when ready. And I can choose to make this simulation public, which is going to provide me a link that I can share and others can view the results of this. So we'll go ahead and set that to make public here. All right, so while this is running, let me give you some background here, what's going on. So when this model runs, it is running tax calculator to compute marginal rates on individual income. Again, those rates on taxes on your savings through dividends or interest or capital gains can affect these marginal effective tax rate calculations. And so it's got to run tax calculator in the background here. It's also crunching a bunch of numbers with respect to businesses. So it's going to return us cost of capital and marginal effective tax rates and other measures of the impact of the tax system on business investment by asset type, by more than 100 different assets, and by industry. And so underlying the cost of capital calculator is a data set that includes kind of total assets held by different types of business entities, C corporations, sole proprietorships, partnerships, S corporations, how they're financed, and what type of asset they are. So again, with more than 100 different assets by those 4 different entity types. And then again, crossed by more than 11 different industries. Okay, so there's a large data set, or relatively large data set, of business tax information or business asset holding information that's relevant here. And is being computed at the same time. We can look at, while this is running, I can also show you what this adjustment looks like. And what we're going to see here is a kind of a view of the JSON file that we could download. And this would be useful if we wanted to share our simulation parameters with others, or maybe run this model on a different Compute Studio run, or on a run on our local machine using the Python API for this model. This JSON separates the adjustments into individual income tax parameters that were adjusted, which in our case were none, and then business tax parameters that were adjusted. And so you can see we adjusted bonus depreciation for property with lives less than 20 years, and then we adjusted the corporate income tax rate. All right. The ability to run this model on this web application is really helped by some innovations by a colleague at the Policy Simulation Library, Hank Dube. And Hank has provided this platform, Compute Studio. He's also been very innovative with respect to how models handle their parameter inputs. And so one of the tools he's created is called a piece of software called Param Tools. And that's what CostofCapital Calculator uses to handle its parameter inputs, which makes it really easy to, for example, build a web application like this. All right, here we are with our results. So there's a few kind of summary results that are presented from CostofCapital Calculator, and that includes a table of kind of a summary table showing the marginal effect of total tax rates under the baseline and reform policy for different types of business entities, corporations and pass-through entities, and separately by how that investment is financed. Okay, so let me walk you through this table to get a sense of what it's telling you. All right, so the first row in this table is the overall marginal effect of total tax rate. And under current law, the baseline policy in this case, that marginal effect of total tax rate is a rate of 17%. All right, so that is less than, for example, the marginal top marginal statutory corporate income tax rate. And the reason it's less than that is because we have accelerated depreciation. It's also less than that because with debt financing, you can deduct your interest payments, and that's also going to lower your marginal effective tax rate on that investment. So we have a marginal effective total tax rate of 17%. This marginal effective total tax rate differs from another output of the CostofCapital Calculator, which is the marginal effective tax rate. The METTR includes those individual level taxes as well as the entity level taxes. So this is the most broad measure of the kind of tax burden on investments. Under the reform, this METTR over all types of investments increases by 5 percentage points to 22%. Okay. In the rows below that, what we see is kind of the breakdown by corporations and for their traditional mix of debt and equity financing. And then corporations when they finance the investment through equity, and then when they finance it through debt, right? So you can see that there's a large difference, for example, between debt and equity finance investments in terms of their marginal effective total tax rate. And this is representative of kind of the reduction in those marginal effective tax rates due to the deductibility of interest that is paid to the debt used to finance new investments. Right. Below the corporate numbers, we see for pass-through entities kind of an overall METTR, as well as separately METTRs for debt and equity financed investments. Okay. And again, you don't see this difference between debt and equity financed investments, where debt finance are face much lower marginal effective tax rates for these pass-through entities, because the interest, again, they're not facing an entity level tax like the C corporations are. Okay, so this is a summary table giving us a sense of, overall, given our reform, how did the tax system change the incentive to invest broadly? Okay. In addition to that table, what we're going to see are three figures, and these three figures help us kind of view, okay, what is, the effect of our reform across industry or across asset? Okay. All right, so the first that I'm clicking on is a view of the marginal effective total tax rate across different categories of assets. So equipment, intellectual property, inventory, land, and structures. And we're seeing the average METTR in these different categories under the baseline policy, which is current law, and under the reform. Okay. So what we're seeing is that marginal effective tax rates increase for each of these categories, but there's different, like if we look across category, that increase due to our reform is, larger under some categories than others. For example, equipment is hit especially hard because right now equipment investments are benefiting from that 100% bonus depreciation, which we're removing. And so they're hit especially hard, and that doesn't apply to inventories or structures who are not currently benefiting from 100% bonus depreciation. Okay, so this first picture will give you a sense of, under your reform, how are you differentially treating investments by different types of, or investments on different types of assets, I should say. The second picture I'll show is a similar bar graph, but this is going to split it out by industry. So we're looking at different industries kind of based on 2-digit NAICS codes. And again, we're seeing the baseline marginal effective total tax rates versus the reform marginal effective total tax rates. And this will give us a sense of how we're differentially treating different industries under current law and our reform. Okay. So again, you can see some industries, in particular those that involve, heavy use of short-lived equipment like information technology or manufacturing, they're seeing the larger increases under this reform, which again eliminates that 100% bonus depreciation. All industries are seeing METTRs go up as we also increase the corporate income tax rate. And then the last figure here is kind of a range plot. And what this is showing us are those marginal effective total tax rates on corporate investments by different type of financing. And the range here is showing us what is that METTR on the asset with the highest METTR versus the lowest, and then the dot in the middle is the average. Okay. And so by doing this, what this is showing us is essentially what is the variance in terms of that tax treatment of different types of investment. Okay, so like if we've got a broad range between the top and bottom METTR, we're having very differential treatment across asset types, or at least that's one interpretation of this. Okay, and so we can see our reform generally increases marginal effective tax rates. The exception to that is when we're facing debt financing. Remember, with debt financing, you're deducting those interest payments, so that deduction is worth more at a higher corporate income tax rate. And so actually increasing the corporate income tax rate there is bringing down, in this case, our cost of financing that with debt, financing that investment with debt. Okay. But we are seeing that kind of, in general, that range is being stretched out under our new treatment, especially for debt financed investments. Okay, so this picture will again show you kind of how your reform is treating different types of assets and investments that are financed differently under kind of current law versus your reform. All right. So those are the default things that are, or pictures and tables that are shown to you as a result of running the cost of capital calculator on Compute Studio. Now, again, these are just some summary things that, give you a good overall picture of how your reform changes kind of the landscape of how taxes affect investment incentives, but they're by no means kind of all you might want to look at. So because of that, we've got the ability for you to just download kind of the full results from your run. And this is going to include a number of different measures, as well as rich detail on how the tax system affects investments across different types of asset categories. All right, so let me click on those results here. All right, so this is going to download 4 CSV files. I'm going to open those up, and then let me share my screen. So let me just share first my Finder window here, showing you what those 4 files are. So first of all, those 4 files are going to give us results by asset and then results by industry. And they'll give it separately for the baseline tax system and then the tax system under our proposed reform. Okay, let me click on one of these. I'll take look at one by asset and one by industry. Let me share my Excel here. All right, so first, what we're looking at here is that CSV file with our results by asset. And so what we've got here is, again, more than 100 different assets. And we've also got things grouped by just overall assets, by broad categories of assets like structure and equipment, and then by very specific asset categories. And we're using BEA asset codes for these categories. And so again, we've got more than 100 of those detailed BEA codes for the different types of assets. All right, so what do we have in the column? So we've got various measures here. We've got effective average tax rates. That's what EATR stands for. So this is following the methodology of Devereux and Griffith. This is explained in the documentation to the cost of capital calculator, which we post a link to that in the chat. All right, so that documentation will give you a sense of what these different measures are, so you can read more detail about how they're computed, as well as find references to others' writings on how to interpret these and so on. But I want to give you a broad sense of how to interpret what is shown in this detailed data that you can download from the Cost of Capital Calculator web application. So we've got measures like the EATR, the effective average tax rate. The suffix on this, _D, that's going to refer to that this is for debt-financed investments. The suffix _E is going to refer to in this case, effective average tax rate for equity-financed investments. And then the suffix mix is going to be a mix of debt and equity, where that mix is based on historical data showing the fraction of investments that were financed by debt or equity, which, as we pointed out at the beginning of this talk, is a parameter that you can change in the Cost of Capital Calculator web application. So you could change this mix and say it's 60-40 or 70-30 financed by debt. But this EATR mix is going to tell you, okay, what is that effective average tax rate under that financing that is a mix of debt and equity. Okay. For other measures of tax rates, like the marginal effective tax rate, again, we have those measures here by debt, equity, and mixed financing. The results that are shown by default in the tables and figures provided in the outputs of the Cost of Capital Calculator web application, the marginal effective total tax rate is reported here for debt, equity, and mixed financing. The cost of capital is given by row, and that is given for debt, equity, and mixed financing as well. And then some other statistics that are computed are the tax wedge, which is essentially the difference between the before and after tax rates of return that are required for the investment. We get the user cost of capital as well. And then also reported is the net present value of depreciation deductions, which you can see is 1 for all the assets we're currently viewing because of that 100% bonus depreciation. Okay, looking at the chat here, I see Peter's got a good question about how might a CEO use the results here to alter their investment decisions. And so if you were a company looking to make investments, this tool provides you the opportunity to kind of simulate what a proposed reform might do to your mix of investments, right? So you can, for example, as we're seeing in this table, get by asset type what the new marginal effective tax rate or cost of capital is under this proposed reform. And you could then use that to say, okay, well, I was intending to invest in, $100 billion in equipment that had, 15-year lives, or you could go through the specific equipment categories here and match up to what your proposed investment might look like and figure out how that proposed tax law, maybe President-elect Biden's proposals, would affect the mix of assets you were considering investing in, right? You can see how it might change that cost of capital, compare that to what you think the return should be for investors and so on, and come to a sense of whether or not under this proposed law, it would make sense to go through with that investment. All right, so I see another question from Richard Evans. He's saying, similar question, the output of the cost of capital calculator model is a marginal effective total tax rate by asset holding, type of financing, and industry. It seems like the next step for these is using outputs to infer how firms will change behavior in response to policy. And so one of the things you could consider, right, is, okay, if for example, this proposal makes equity financing look more attractive than debt financing, right, we might think one might change their mix of debt versus equity financing. And we're not computing in this model the responses, but one could, for example, if the hypothetical CEO in Peter's question was wishing to look at how a proposed law might change their tax burden on their proposed investment, they could run this simulation with different mixes of debt and equity financing and look at the resulting cost of capital under those different mixed financing regimes, right? And so, identify what might be, obviously in this case, more debt financing is going to be helpful, but they would know the trade-offs of if we're borrowing more, maybe those borrowing costs go up, and they could run that simulation of how that cost of capital calculator would change as they change that mix of debt and equity financing. So that's something you could do with this model currently, but there's not a behavioral response built into this model. But it's something that if you were to predict for your own sake how you would change your mix, that's certainly a parameter you can adjust in this model. And you can adjust those borrowing costs as well, the interest rate paid on the debt for borrowing from the corporation or the pass-through business. All right, so let me just open up one more table here, and I'll just show you by industry, the results are going to look very much the same. So we're going to have the columns are going to be those different measures of effective tax rates, average effective, marginal effective tax rates, cost of capital, and so on. And now by industry, the rows are just the different industries, as well as, with very detailed industry splits, in this case, much more detailed than provided in the figure. But you also get a sense of, in those 2-digit NAICS code industries, what the splits look like, and then overall what the marginal effective tax rate is. So that is provided in the results by industry. All right, so kind of gave you an overview of using the cost of capital calculator. I'll share a link as well to those results, or that run that we just did. So that'll be available in the chat. And it's something you can refer to go back and look at, what would happen if we change some additional parameters, or just get a sense of what this run would look like under alternative economic assumptions or other scenarios. All right, so again, thanks for watching this video. If you have questions, feel free to navigate to the cost of capital calculator repository And you can post an issue there, as well as finding the PSL discourse forum. That would be a good place for non-technical questions about how to use this model. Okay, so thanks a lot for viewing, and we'll see you soon. Bye.